What's up everybody, Nate here, and the Federal Reserve just made a historic move, raising its benchmark interest rates by 75 basis points for the third consecutive time. Not only that, but Federal Reserve Chairman Jerome Powell reiterated that the Fed is committed to its goal of 2% inflation over the next couple of years. He did say though that the US economy is most likely going to be facing some pretty serious pain in order to get there. In response to this, the stock market across the board pretty much sank as investors believe that this is just the beginning of a more restrictive economy and a possible long recession. So today I want to talk about this brand new report released from the Federal Reserve. I want to talk about everything new. I want to go over all of Federal Reserve Chairman Jerome Powell's statements, and I want to discuss how this is going to affect our economy and what all of this means for the future of our country. All right, so let's go ahead and get into the numbers here. So like I said before, the Federal Reserve has raised its interest rates by 75 basis points or 0.75%. This is the third time that they've done that, and now the federal funds rate sits at around 3 to 3.25% in the United States. This means that the federal funds rate and the borrowing rate for a lot of banks and financial institutions is going up, making it a lot harder for them to get money, and while that leads to a more restrictive economy. So with them raising their interest rates this high, now you're above that neutral level, so now you're in restrictive territory, and it's going to be much more difficult for consumers and investors and businesses to borrow money. The Federal Reserve hopes to get the federal funds rate at around 4.6% by the end of 2023. So that means we have around another year and a half of the Federal Reserve raising its benchmark interest rates in order to bring down inflation. That is the whole purpose of them raising their rates in the first place, because inflation is pretty much out of control in our economy, and that means prices are also out of control. The way that we measure inflation on a month-over-month basis is with the Consumer Price Index. The CPI report basically takes a basket of all the goods and services in our economy and measures how the average prices are going up and down. Over the last year and a half or so, prices have gone way up, around 9.1% as of June. Now that is a well over 40-year high, and while inflation has come down a little bit, Jerome Powell believes that inflation really isn't going anywhere anytime soon, and that's why he believes the Federal Reserve needs to be a whole lot more restrictive. In addition, the Federal Reserve is now maximizing its quantitative tightening program, so it's rolling off around $95 billion worth of its assets every single month starting this month. That means a whole lot less money for the stock market, and that's another reason why stocks actually went down today. Now the federal funds rate in the United States sits at around 3 to 3.25%, the highest it's been since 2008, and the Federal Reserve and Federal Reserve Chairman Jerome Powell believe that this number has got to go a whole lot higher if we want to bring inflation down. Over the last couple of years, the Federal Reserve had their interest rates at 0%, and that meant a lot of money was circulating around, and that meant that there was a whole lot of money being printed and pushed into things like the stock market. Every single market in the United States suddenly exploded, with values going up and prices going way up, from the cryptocurrency market to commodities to the housing market to the stock market, and it also went into other things like prices for food and shelter. All of these things started to go up in price, but with everything going up so quickly, that immediately means that Americans now just need more money in order to buy more things, and that devalues your currency over time. And the Federal Reserve believes that this is the fight that they need to take on, even if that means that the entire economy is going to have some suboptimal growth in the future. The Fed believes that this inflation problem is way bigger than a few years of economic shrinking, so they want to do whatever they can to bring inflation down, and they're going to continue to raise interest rates aggressively and quickly in order to get it to that 2% mark. And according to Jerome Powell, nobody really knows what that means for the economy. It could be a really long and terrible recession, or it could mean a soft landing, depending on a lot of other factors in our economy today. He said that nobody really knows what's going to happen next because the Federal Reserve does not know how high they actually need to raise their interest rates by in order to start bringing down inflation. They noticed that inflation, even though they've been raising their interest rates pretty much throughout 2022, has not really had a big effect on inflation just yet. So they don't know when that's actually going to start happening, but it could mean that rates go much higher in order to bring inflation down. And like I said before, that means everything in the economy is restricted. The Federal Reserve essentially controls demand with its monetary monetization in our economy. So when they raise their interest rates, that means it's a lot harder for people to borrow money, especially people trying to get a mortgage or an auto loan. The way that you get those loans is you have to be able to make the monthly payments. And when interest rates go up, a lot of Americans are just barred from getting those type of mortgages because they can't afford it anymore. And the same thing can be said for businesses and investors who are trying to take on debt. They can't take out a loan and actually make their money back because they're going to be paying so much more in interest. What that immediately does is, well, people are not going to be spending as much money in the housing market. People are not going to be spending as much money in the auto market. They can't spend as much on credit cards because all of those have an adjustable interest rate. And now businesses can't grow as quickly as they could before because investors are not willing to put as much money in debt into a lot of these companies. In theory, that will bring down demand a whole lot in our economy because now nobody is spending any money and it's really hard for you to spend money. The Federal Reserve doesn't want to make it impossible to spend, but they want to make it really difficult. Of course, the Federal Reserve can do the opposite. They can lower their interest rates and boom the economy immediately because now all of the opposite things will happen, right? People can invest in businesses much easier because they're going to make a bigger profit. People can get a mortgage and save hundreds of dollars every single month because the interest rate is lower. People can spend on credit cards and so on. There's a whole lot more money circulating around. But inflation poses a lot of big threats to our economy in 2022 and beyond because as you have really high inflation, you also have really high prices. And when prices go up really quickly, people now need a whole lot more money because the buying power of the dollars that they currently have can't buy them as much. So they need more money to buy all of the same things, which means wages need to go up. And that means businesses are going to have higher costs. And eventually they will trickle those costs down to American. And that's why inflation continues to rise time and time again. Now, it's important to mention here that there are a lot of factors that affect inflation. It's not just the Federal Reserve's money printing and it's not just their monetary policies. That has a huge impact, but there's a lot of other things that control some parts of inflation in our economy. Things like supply chain problems and energy shortages have led to really high inflation in the United States. Gas prices going up over the summer, that contributed to inflation. Inflation in the housing market with prices for supply and demand going way up, that contributed to inflation. And with China and other countries not able to produce as much because of the pandemic, that of course contributed to inflation here at home. We simply don't have as many things to buy like we did before. And with all of the money printing that we had over the last couple of years, that meant that, well, people have all of this money, but they can't really buy anything. And when they do buy things, they're buying up everything, which means companies have to make it a little bit more difficult for people to buy as much. That's why we see prices going up. But at the end of the day, while you did have some supply chains healing over the last couple of months to the last year, that really hasn't meant inflation has come down in our economy. It's still really high, and that signals to the Federal Reserve that there is still too much demand and too much money circulating around. So they have to suck all of that demand out, which is exactly why they are raising their interest rates. They want it to be a lot harder for people to go out and spend money, and the higher their interest rates are, the less money people will spend. Jerome Powell says on the shelter front, prices are probably going to be very high there, and prices are still going to be very high in the United States until the Federal Reserve can find that line between raising their interest rates and causing a recession. Now, here's exactly what all of that means. With the Federal Reserve raising its interest rates aggressively, well, then it's a lot harder for people to spend money. We definitely know that, but what the Federal Reserve is trying to accomplish here is actually some unemployment in the United States. Right now, our unemployment rate is at around 3.7%. The Federal Reserve believes this is way too low. It's not sustainable because there's way too many people making a whole lot of money. And over the last couple of years, this has been a really unique problem. Because of things like the Great Resignation, people have quit their jobs. And as they went to a new job, one of the things that they asked for was better benefits and, of course, better pay. Now you have millions of Americans that are making a lot more than they did before, and businesses in 2022 simply can't pay them enough. So businesses are now having to lay people off. And because there was so much investor liquidity and so much investor debt out there in the stock market, remember, the stock market hit a record high at the end of 2021. Businesses had so much money and it was totally fine for them to throw it at employees. They were actually even hiring more employees than they probably could sustainably and effectively take on, but they were doing it anyway in order to meet demand and, of course, grow their company while they can. Now they're having to draw all of that back, which means more layoffs and higher unemployment. But this is exactly what the Federal Reserve wants. It's all part of their orchestrated plan. They want people to be unemployed. They don't want everyone to be unemployed, but they do want unemployment to go up in the near to distant future to around 4 to 5%. This means that people are losing their jobs, and if people lose their jobs, then they're not able to buy things, and if they can't buy things, naturally inflation starts to come way back down. The Federal Reserve also wants businesses to not hire as many people in 2022 because they may have to overpay them, which is a problem because they're not really going to be able to keep them. And if job postings actually do start to decrease in 2022 or in 2023, then this signals to the Federal Reserve that their tightening is working and the labor market is getting a lot smaller because Americans have to take whatever job is available. They don't really have as much power anymore, which means they don't have as much power to negotiate their salary. All of that means a whole lot less spending, and that means that there's going to be a lot less spending for businesses. There's going to be a whole lot less spending for investors trying to invest in these companies, and the bottom line is because of this rate hike and future rate hikes, the entire economy is most likely going to shrink. That is exactly why the stock market is so freaked out right now, because they don't know how high the Federal Reserve is actually going to go before they can start lowering inflation, because the bottom line is the Federal Reserve can't really lower inflation alone with its interest rate policies. It doesn't have a direct effect on it. Think of it this way. With the Federal Reserve raising its interest rates, that means it's harder for people to borrow money. But how is that really going to affect the prices for food in the United States? The answer is it really doesn't, and the Federal Reserve knows this. So why are they still raising their interest rates? Because, well, that's all they can do. They can't really control any other aspect of our economy. They can only raise and lower their interest rates. So in doing that, they are going to cause a whole lot of unemployment. And if unemployment goes way up, then people don't have as much money and inflation comes down. Prices can come down or at least remain stable because there's fewer Americans buying things. The businesses on the New York Stock Exchange know that they're probably going to have to fire people, and they know that people are going to have a whole lot less money, so they're not going to have investor liquidity, and they're not going to be able to make any of that money back in sales, meaning they can't grow as fast either, and the stock market is all about growth. If they can't grow, then the stock market goes down. And again, depending on how aggressive the Federal Reserve gets here, and depending on how high they keep those interest rates at, we could see a prolonged period of economic shrinking in the United States. A lot of experts believe that the Fed might not start to turn around their interest rates until around 2025. They're going to now stay above the neutral level till around 2025. So we're not going to see the federal funds rate hit around 2.25%, which is the neutral level till then. And the fact of the matter is this is all an estimate as of right now, and the Federal Reserve has not really been too great with its estimates over the last couple of years or so. They're saying that their rates are going to be at 4.6% by the end of 2023, but that's all assuming that inflation definitely is going to come down. If inflation really hasn't come down at all yet, then they're going to get even more restrictive, which means a lot less spending, and of course it means a lot less money for companies. Not only that, but every single market in the United States is slated to shrink. A lot less people are going to be entering the housing market because it's really, really difficult for you to afford a mortgage. The average 30-year fixed mortgage interest rate right now is around 6%, but that could go up even higher to say 8% or 10%. And now it's really difficult for anybody to get a mortgage. Nobody's going to want one, which means prices are going to massively fall all throughout the United States. The same thing is going to happen in the cryptocurrency market and the commodities market. Every single market is going to get hit, and consumers are going to get hit too because they won't be able to spend as much money either. All while inflation still stays pretty high in our economy because, again, the Fed doesn't really control inflation outright. They only control certain aspects of our economy, but if we still have really bad energy problems, if we still have really bad supply chain issues, then the Fed raising interest rates really isn't going to help. All it's going to do is hurt. But they still have to bring down inflation in our economy because they want the value of our money to be strong, and they want the United States dollar to continue to be the reserve currency. Other nations in the world are starting to drop the United States in their debt cycle because, well, the US is having really bad inflation problems. And the less our money is worth, the less other countries are going to want it. And the US can't really have that if it wants to stay a global superpower. On top of that, they can't really have the wage price spiral get out of control, like I mentioned before, so they have to bring down inflation. And to them, that is a much bigger issue than our economy going into a small recession for the next few years. So what we can expect to see in the future is a much more aggressive Federal Reserve and probably several more 75 basis point or higher interest rate hikes in our economy. Not only that, but we probably can expect a much slower economy, which means the stock market is going to be extremely volatile because these businesses are not going to be making as much money. They can't grow as fast, so these investors are not going to be making as much of a profit, meaning they're not going to be putting as much money in, and the stock market is most likely going to go down. All of the other markets throughout the United States are probably also going to go down too, namely the housing market. As the Federal Reserve raises its interest rates, mortgage demand is going to sharply decline all throughout the country, meaning people can't afford a mortgage, which means prices are going to come down and supply is ultimately going to rise. All of this is to bring down this big inflation problem in our economy, which will eventually happen, but at the expense of a possible long-standing recession, because there is now a bunch of people who are unemployed in our economy and they can't spend any money. Will it work? Probably, but like Jerome Powell said, we're most likely going to see some pretty serious pain over the next couple of years. And at the end of the day, the Federal Reserve is committed. They're not going to lower their interest rates until they hit that 2% mark. They've said this time and time again, so that is what we can expect. Right now, inflation is at 8.3%, so they've got a long way to go, and they said that they're going to keep at it until inflation is down. Their next FOMC meeting is in November, and probably a fourth consecutive 75 basis point hike is on the table as of now, which means we are in restrictive territory for our economy and a slowing growth period for our economy. And now we are definitely on the other side of the tipping point. But now I want to hear from you on this issue. What do you think about the Federal Reserve's most recent interest rate hike? Do you think that the Federal Reserve is going in the right direction, or do you think what they're doing is going to crash our economy and keep inflation high? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.